how they do that synthetically, again, to apply to capital markets. Because capital markets are a complex dynamic system. So we've had 60 or 70 years. I mean, complex systems have been around since the Big Bang. That was one of them, so 13 billion years. But we've had, really since 1960, it developed as a science, and partly because we needed the computing power. And it works really well in so many fields. And then one of the things I said was, why couldn't it work in capital markets? And the minute I said that and started looking at it, it was like, oh, this actually describes what's going on. It's not a bell curve, it's a power curve. It's not an equilibrium method, it's a very inefficient method. I once looked at the list of all the Nobel Prize winners in economics, and I estimated about a third of them were for things that are just wrong, like empirically wrong. Efficient markets aren't efficient. Why the stock market fell 22% in one day on October 19th, 1987? What's efficient about that? But there are these other tools that you can use. I've had meetings in Los Alamos, and I said, we can crack the code here. We get some physicists, applied mathematicians, psychologists, an economist, a lawyer, get an eclectic, real diversity, not the other kind of fake diversity, and just work as a team science, and crack the code in capital markets. Like, we love that. Like, what a great idea. Let's put that in some kind of proposal. Let's get some funding. Let's do it. I talk to PhD economists. They say, you have nothing to teach us. Like, would you want to join this team? Like, why would I want to team up with a physicist? Or, Matt, we have it all figured out. So I'm like, okay, so the impediment to improvements in economics are the economists themselves, because they don't know what they're missing.
And it's relatively early, I think. I mean, when I first started looking at it, I just got to Wall Street. And just because I'd been on a junior hockey bus, I'd always read and read and read and read. And I ran into all this literature from the Santa Fe Institute, which is essentially, when it was only in the late 1990s as this came to be, so it was relatively new material. And I was like, wow, this makes more sense. And of course, I just came out of a liberal arts education where that's kind of how you learn, or at least they teach you to be a little bit around the rim on everything.
Right.
And I'd been taught by Schiller and Mandelbrot. I mean, so there were a lot of, like, there's mean reversion, there's this, there's that. And that's why, like, there's a brilliance to what you do, at least according to me, because I find this to be the better way. And this is like a real appropriate thing. There have been some Nobel Prize with it. Like, if you think about Herbert Simon, which is one of the best books I think is ever written, because it's by a polymath, essentially. Yeah, and here Charlie Munger and Buffett cite that as one of their favorite books, but nobody ever talks about it.
Yep. Well, I only disqualified a third. There are 2/3 that I think did some good work. So yeah, I agree with you on that.
Yeah, it's a fascinating thing. I said I wasn't going to start with your book because I want to start with fraud, crypto fraud. But lo and behold, you just start talking, and I'm like, well, he just actually started this book with a quote from Matthew that essentially does incorporate where I think people got screwed. His quote, for those of you that haven't read his book yet: "To anyone who has, more will be given, and he will grow rich. From anyone who has not, even what he has will be taken away."
Right.
And that's the thing.
The first thing that strikes me about the whole crypto world, there is no wealth creation. It's just, the best metaphor I've been able to come up with, they're casino chips. You go in the casino, put your money down the roulette table, croupier gives you a pile of chips, you gamble them. You might win, you might lose. But when you're done, those chips aren't, all you can do is take them to the cashier and get your money out. You can't take them out on the street and spend them. In other words, it's a token inside a closed environment that can be, you can make or lose money, I'll grant that, but it's not good for anything else. So I started out with kind of this: crypto is a token that only has any value in the crypto world. Now, what happens when you want to get out of crypto world? You say, I'm ready to cash in my chips, I'm ready to go to the cashier, here are my tokens, give me my dollars. Well, Sam Bankman-Fried's answer was, we're closing the cashier window.
Exactly.
You can't have it. The other thing that strikes me about this, and this is been fascinating. Okay, the coins themselves, Bitcoin, whatever, I think I have a pretty good handle on those at this point. But I watched this infrastructure be built, and it basically mimicked the Wall Street infrastructure. It wasn't just coins after a while. It's like, well, we need custodians, we need exchanges, we need technicians got involved. They start doing, these candlestick charts and 200-day moving average. And I know all that from Wall Street, right?
Yeah.
I've been doing that for 40 years. I'm like, wait a second. You're acting like the research department of Goldman Sachs, thinking about, like Tesla, for example. You may love it, you may hate it. That's a choice. But they make real cars. There's a car there. And it doesn't have to be tangible. It can be intangible. It can be an insurance company. That's an intangible product. But you get real insurance and you make a claim, they pay you. So the Wall Street infrastructure, technical or fundamental, trading, exchange, custody, all that, exists around some real stuff. Again, tangible or intangible. Here, you've mimicked the infrastructure, but to quote Gertrude Stein, there's no there. And a lot of the money that's been made in crypto world is not, I bought a token and it went up. It's, no, I own an exchange, and Sequoia or somebody, gives me a $25 billion valuation. I'm a 90% stockholder. I must be worth, whatever, 20 billion plus. So, and that's all crumbling. And it's going to continue. What we both know about how complex systems collapse is there's a cascading effect. The water does not go back up the waterfall. It just keeps cascading down. So we've seen Genesis is reported, considering bankruptcy. They haven't filed yet. There were other exchanges that have filed for bankruptcy. It turns out that some of these exchanges, they had all these coins, and they put it with FTX in custody. FTX was their custodian. It's like, well, I got some. I'll deposit it with FTX. Of course, they're not getting it back, so now I can't pay my people. I'm going bust. So we're seeing these cascading failures in crypto world, and we'll see more. The question I'm studying and asking is, at what point does that leach over into the real financial world, the world of real broker, the Lehman Brothers of the world, et cetera? And I expect it will, but these things don't happen overnight. Everyone's like, you wake up the next day, oh, it's all good. What people don't realize, and the data is there, just look at it. So the 2008 global financial crisis, everyone knows, September 15th, 2008, midnight on a Sunday, Lehman Brothers files for bankruptcy. It was electronic filing. They shot it in around midnight on a Sunday. But that started in July of 2007. There were the two Bear Stearns hedge funds. Not Bear Stearns itself, but the two Bear Stearns hedge funds collapsed. I think it was Societe Generale closed a money market fund. They closed the gates on a money market fund. And then, Jim Cramer's on with Aaron Burnett, and that was just, they know nothing, they know nothing. He was actually right about that because he was talking about the Fed. That's easy to say about the Fed. They just say they know nothing and you got it. And then Bernanke cuts, I guess, the discount rate, which is kind of irrelevant. But Bernanke's on the record that whole summer of 2007 saying, yeah, we got some stress in mortgages, but it'll blow over. So when did it hit the peak? Well, the answer was a year later. It took a year for that to go around. The stock market peaked in October of 2007, 6 months after the crisis started. That's when the stock market peaked. Then in December, they went around. I talked to some of the seniors who did this, Temasek, Kuwait Investment Authority. They went to the major sovereign wealth funds, and they basically bailed out Wall Street at that stage. And then there was quite a little bit in the winter of 2008, but then boom, Bear Stearns in March, Fannie and Freddie in June, and then Lehman in September. I remember just a quick anecdote. I was, for about 5 minutes, I was an economic advisor to the McCain campaign in August of 2008. It was right after the Congress passed the bailout legislation for Fannie and Freddie. And I'm on the call, all the names, Douglas Holtz-Eakin and John Taylor and all these guys, and they're high-fiving. They're like, great, the crisis is over, and we can get back to Iraq, because we really want to talk about Iraq. And I said, excuse me. I said, this crisis is not over. This was in late August. I said, you are not going to make it to Election Day without a major break in this crisis. It's going to get a lot worse. I didn't say for everyone knew Lehman. I mean, they were always the weak link. It's not the question I had today. I said, you're not going to make it till November to Election Day without a crisis. I said, so get your guy ready, write a speech with a 4-point plan. It doesn't even matter what the points are, just have 4 points. Stand them up on the steps of the Treasury and say, my fellow Americans, we have a crisis. Here's my plan, my 4-point plan. You'll win the election. I was laughed off the call. I was not invited back. And then when it actually happened within weeks, McCain ran around like a chicken with his head off. He was white anyway, but he's kind of pale white. And then he barges into the White House. He says, we got to have a meeting in the Roosevelt Room. So Bush, to his credit, said, well, I can't, there's a campaign going on, an election going on. I can't meet with you without meeting with Obama. So they bring in McCain, Obama, and George W. Bush. And they're all sitting around, I think I'm in the cabinet room, actually. And there was a photo op. Obama didn't know any more than McCain, but he was smart enough to keep his mouth shut, just, be cool. And the American people saw this. This guy's scared to death. This guy's cool. I'll vote for him. And if you look at the polls, McCain was running ahead until that meeting I just described, right after Lehman. And then that's where Obama went ahead and McCain came down. Everyone blames on Sarah Palin. I mean, that's a separate story. But those poll lines down and up crossed around Lehman. And so, missed opportunity. But it just goes to show how these things take a while to come around.
Yep.
Just really quickly, same thing with 1998, long-term capital management, Russia. That started in June 97. And then it went, Malaysia, et cetera, South Korea, quiet period, then comes back. So they take a year to go around. So I don't think we've heard the end of the story.